Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In the previous session, we covered the 4 most common types of fraud in the balance sheet. Keep these in mind while perusing financial reports, and you should be able to avoid common pitfalls. In this session, I shall touch upon current assets and non-current assets in the balance sheet to help you understand return on assets of listed companies. Return on assets, or ROA for short, is a key metric to assessing the utilization efficiency of a company's assets and is very useful for our investment decisions. First, look at the formula. ROA equals net income divided by total assets. We covered net income in previous sessions. What does total assets consist of? From the chart below, we can see total assets equals current assets plus non-current assets. Current assets refer to assets with high liquidity. They include cash, cash equivalents, short-term investments, accounts receivable, inventory, etc. If a company's operation starts to deteriorate and working capital begins to dry up, current assets can be quickly sold for cash, which will help the company navigate through a crisis. Non-current assets refer to assets with no short-term liquidity, cannot be sold for cash within 1 year. In the balance sheet, non-current assets are booked under current assets and include long-term investments, fixed assets, goodwill, intangible assets, deferred tax assets, etc. The sum of current assets and non-current assets is total assets, which is the denominator of ROA. Thus, it is important to study current assets and non-current assets in detail. First, let's look at the items under current assets. 1. Cash and short-term investments. Warren Buffett once said the first item he looked at in the balance sheet is the amount of cash and short-term investments. If a company has high volume of cash and short-term investments, it will fall into the following 2 scenarios. 1. If a company can continuously generate a large amount of cash, this company has strong competitive advantage. 2. The company is faced with operating problem as it just sold part of its business or huge amount of corporate bonds. Generally speaking, it happens when the company faces stiff competition or business transformation. In both cases, the company is having a hard time. Warren Buffett also added that investors should figure out the source of the cash and short-term investments. How to make that happen? You can check the company's balance sheets in the past 5 years, which can tell you the cash come from its operation or from a one-off event. 2. Prepayment. Prepayment means that a company pays now for goods or services to be received in the future. Although the company has not yet received the goods or services, as long as the purchase contract is signed, the company will book the goods or services as assets. 3. Accounts receivable, inventory. Accounts receivable and inventory are important accounts under current assets. We have covered them in the previous session, so we won't go over that info again here. As the above accounts all impact the amount of current assets, we should pay close attention to them. As these items affect companies' current assets, we should pay close attention when we read balance sheet. Now, we will look at the 2 key subjects under non-current assets. 1. Intangible assets. Intangible assets refer to assets that cannot be seen or touched. They include patents, copyrights, trademarks, brands, etc. The SEC rules do not allow companies to include internally generated intangible assets on their balance sheets. That is, companies do not determine the value of intangible assets such as patent rights and brands that they generate. The value of intangible assets can only be reflected in acquisitions by third parties. When a company is acquired, its intangible assets will be booked in the balance sheet of the acquirer at a reasonable valuation. If an intangible asset, such as a patent, has limited economic life, it will be amortized over its economic life, which will be reflected in the income statement and balance sheet. 2. Deferred tax asset and deferred tax liability. We all know that a company's audited assets need to be reported to the tax authorities. If the authorities derive different results for companies' income, companies will pay for or get deferred tax. If the income calculated by tax authorities is more than the company's results, the company has deferred tax assets. However, if the income is lower than the company's results, the company has deferred tax liabilities. 3. Fixed assets and goodwill. Fixed assets and goodwill are important parts of non-current assets. Since we have covered both concepts in the previous session, we won't go over that info again here. Again, the sum of current assets and non-current assets is total assets, which is the denominator of ROA. Then, is a higher ROA necessarily better? Let's find out. ROA measures the amount of net income per dollar of assets. According to the formula, the higher net income means the higher the ROA. Many Wall Street analysts believe that a higher ROA is a good sign. Well, I beg to differ. Warren Buffett believes that a higher ROA may imply that a company's competitive advantage is unsustainable. For example, according to our data, in 2021, the total assets of Coca-Cola were $87.2 billion, and the company had an ROA of 7%. The total assets of Procter & Gamble were $119.2 billion, and the company had an ROA of 9%. The total assets of Moody's were only $12.4 billion, yet the company had an ROA of 15%. This means large companies with higher total assets may have a lower ROA, while growing companies with smaller assets may have a higher ROA. If you have $50 billion to build up a business, will you choose to compete with Procter & Gamble or Moody's? Well, $50 billion is insufficient to compete with Procter & Gamble. However, we may have a chance against Moody's. From this perspective, while Moody's has higher ROA than Coca-Cola and P&G, it lags behind in terms of sustainable competitive advantages. Due to low cost of entry, Moody's is faced with more competitors ahead. Therefore, in assessing ROA, investors shall analyze a company's total assets from multiple angles. A good company tends to have high total assets and industry-leading ROA. Okay, let's summarize what we have learned today. In the balance sheet, there is an important ratio called ROA, which measures the amount of utilization efficiency of assets. A higher ROA is not necessarily better. We need to take other factors into consideration when making an assessment. I hope you've benefited from this session, and I suggest that you use the knowledge to analyze real financial reports. See you next time!